All right, over the weekend, the federal government took extraordinary steps to avoid a potential bank crisis after the historic collapse of California based Silicon Valley Bank on Friday. U.S. regulators said yesterday that they would guarantee all deposits for customers of Silicon Valley Bank, whose failure is the second largest in U.S. history and the largest since 2008 in that financial crisis. Prior to its collapse, Silicon Valley Bank ranked the 16th largest bank in the U.S. based on assets. So, what triggered this, and what could be the implications of the bank collapse and the government's response? We've learned to be leery of the government stepping in post the coronavirus. Well, joining me now to talk about this is E.J. Antoni, research fellow in regional economics with the Heritage Foundation Center for Data Analysis. EJ, welcome back to Washington Watch.
Well, thank you for having me.
So, for those that really hadn't been paying attention over the weekend, explain exactly what happened. Kind of break that down for us, will you?
Certainly. So we're talking about a bank that essentially put itself into an incredibly risky position. In fact, I would go so far as to say it put itself in a position that doomed it to failure. It was only a matter of time before it would eventually collapse. And that's exactly what happened. So that the bank had more claims for deposits than it actually had money to give to customers, at which point federal regulators stepped in, closed the bank, and now we have a full-fledged bailout, unfortunately, where people who had money in this bank, which was not guaranteed, now it has become guaranteed, but at taxpayer expense.
So, you said this was based upon their actions, their policies. It was almost guaranteed to fail. What were they doing?
So what they did is they basically relied on interest rates staying incredibly low, more or less forever, which obviously could not happen. Eventually, rates had to rise. And when that happened, they were hit on two sides, both in terms of their depositors who needed to take cash out of the bank as interest rates rose, but then they were also hit from the standpoint of the investments that they had. In other words, where they put their money was also dependent upon low interest rates. And as interest rates rose, those investments actually lost money. So at the very moment that they needed to sell investments in order to get cash to pay depositors, those investments had lost value. So they could get a minimal amount of cash and they very quickly were upside down, or in other words, insolvent.
EJ, to me, that just doesn't make sense. Why would they do that? I mean, that, as you said, that almost guarantees failure. So why would they do that? Were they not, I mean, did they take their hands off the wheel? Were they distracted by the ESG, the woke policies that the left is pushing, that they were more focused on other things rather than their fiduciary duty?
Well, I think it speaks volumes when this institution, for example, had a diversity officer, but it hasn't had a risk management officer for the better part of a year. I mean, again, that just speaks volumes about where these people's priorities were. But furthermore, this bank actually had financial instruments which served as a hedge, essentially, against interest rates going up. In other words, they were protected, but they sold those financial instruments in about December of 2021. So they increased their leverage and increased the riskiness of their position quite knowingly, which again is all the more reason why taxpayers should not be bailing out poor management who knew what they were doing and knew the risks which they were assuming.
So it goes back to what I said in the open. I mean, we've kind of grown leery of government movements like this because when government goes to bail out, there are unintended consequences, as we've seen with the infusion with the American Recovery project of Biden, and there's trillions of dollars that have been pumped into the economy that have caused interest rates to go up, inflation to soar. So, I mean, what might be the unintended consequences here?
Oh, goodness, it is really difficult to overstate the amount of moral hazard that has been created here. In other words, the incentive that we have now provided for bad actions. There's literally zero incentive now for either depositors or banks to care about the safety of deposits. Why? Because the Federal Reserve now will jump in and bail anyone out as soon as things go south. So we are creating more systemic risk not less here. Furthermore, this entire situation was only made possible by the fact that the Federal Reserve kept interest rates far too low for far too long, which flooded the entire system with trillions of dollars of low interest rate bonds, which was one of the key instruments behind all of the banking problems that we're seeing right now and these collapses.
So they just kind of assumed this was going to go on forever and we can use this cheap money and there's never going to be a day when things would change. So they, I think, just kind of got lost in that, not using good economic principles and insight to plot a way forward. So let me ask you this, EJ. We've seen this now with two banks. There's, the industry is unsettled. How widespread is this? Is this isolated to a few knuckleheads out there with green eye shades, or is this more widespread?
You know what? In terms of how widespread it is, it's a very difficult question to answer because it's more so in terms of the number of banks. In terms of the total percentage of depositors who are at risk, that's actually very, very small because most depositors are at one of the very large banks and they are extraordinarily well capitalized right now. They have a tremendous amount of interest rate risk protection. So those deposits really are perfectly safe. The problem is these smaller regional banks. But I mean, depositors at this point really have nothing to worry about because the Fed has essentially announced that they're just going to step in again anytime anything goes south, and they're just going to more or less create the money out of nothing to make everyone whole. I mean, you can only imagine what this is going to do to inflation.
Well, that's become the government's approach to everything. And I use another completely different area to analogize, but that would be how we've responded to natural disasters. I recall back in my home state of Louisiana after Katrina, and George W. Bush was kind of shamed into just throwing billions of dollars into that situation in Louisiana, and it was not well spent. And so now with every subsequent natural disaster, the federal government has been there with a blank check. And that's part of the reason we have $32 trillion in debt. I mean, this is only going to fuel our national debt.
Right. And this, unfortunately, has gotten us into a very vicious cycle where the Federal Reserve needs to reduce interest rates in order to finance all of these trillions of dollars in bailouts. But those low interest rates are precisely what causes the misallocation of investment, which sets the stage for the next crisis. And so as interest rates go up to fight the inflation, which was caused by the low interest rates, those rates rise and they cause the bubbles to burst. And now we are right back where we started, where interest rates go down again for the federal government to spend more money to bail out these bad actors.
So is it possible that we'll see a change in regulatory procedures by the federal government? I mean, not that I think is good, but I mean, they're going to have to do something to stymie the contagion here by having, as you pointed out, there's no natural incentive to do a good job now because the government's going to bail you out no matter what you do. So might we see another wave of regulation?
I mean, it's certainly possible, unfortunately, but it's exactly the opposite of what we need. We don't need more regulation. What we need is to enforce the regulation that's actually on the books, and we need to enforce the rules of the game that are already on the books. For example, deposits are insured, or at least they previously were insured, up to $250,000. And now with this latest move, any amount of money is insured, even though people don't actually pay for that much insurance on their deposits. So what's the end result of that? It's these banks are now going to have to charge more fees to cover the higher insurance premiums from the Federal Deposit Insurance Corporation. I mean, this once again is just going to be a cost to taxpayers.
So it kind of snowballs. Some are making the analogy I made reference to earlier, 2008. Do you see this as triggering something, or is this just a few isolated incidents of stupidity or misguided priorities?
This does seem widespread, but only among certain classes of financial institutions. And so again, the large banks, ironically, which were so problematic in the last financial crisis, now actually seem like they are in much better shape. And they're actually the ones who are probably going to have to bear a lot of the costs of bailing out these smaller, less regulated and less well capitalized institutions.
So people don't need to be running to the bank to get money to stuff in their mattress. We just need to stay the course. Short term, things are going to be fine. Long term, we've got to make some changes in how we deal with these crises that come up. And I'll just tell you, as I see it, it's political. I mean, you have the left that deals with it one way, the right. Although I will say, in hindsight, and obviously hindsight's 2020. But even the Trump administration, I think, overreached in its response to the coronavirus by allowing entities and businesses to be shut down and then feeling obliged to bail them out. We're going to be paying that price for decades to come.
No, that is exactly right. It's spot on. And it just goes to show you that this is about policy and not politics here. Both sides have been extraordinarily guilty in their fiscal mismanagement and their monetary malfeasance of this situation. And again, every time they do so, it sets us up for the next crisis. And every time they put off the pain by instituting one of these bailouts, it makes the next crisis that much more inevitable and that much worse for taxpayers.
I want to go back, EJ, we got just a couple minutes left, but I want to go back to something I brought up just kind of briefly. But that is the environmental, social, and government standards, the ESG standards that many of these woke corporations are pursuing. You mentioned they have a diversity officer. They didn't have a risk management officer. Might this be an opportunity to look under the hood to see if all of these left-wing ideas are causing people to take their eye off the ball and head down the wrong trail?
It's a really, really great point. And if you look at the kinds of businesses that this bank was disproportionately invested in, what we find is these so-called green energy companies. We even find some of them are Chinese companies. They're not even American companies that we just bailed out in some cases, but they are disproportionately things that would be I guess you could say left-wing ideological companies, right? And so what we've essentially done here is Solyndra, but on steroids. If your audience remembers that infamous company, that green energy company that failed during the Obama years, because these are businesses that, first of all, were financed originally with taxpayer dollars, and now they're being bailed out again with taxpayer dollars. And so you can look at the companies that have done quite poorly recently. Again, they disproportionately are invested in these so-called green energy technologies, but the coal, oil, natural gas, and nuclear investments, those are humming right along very reliably.
Yeah, but they're not the favored industries of this administration. But this is what you have when you have government, I wouldn't say involvement. I mean, this is interference. And I mean, they're picking winners and losers by the policies and the money that they give to these entities. I mean, we're quickly losing the whole idea of free enterprise and capitalism.
Right. They are picking winners and losers, and they're also changing the rules of the game in real time. I mean, no longer are deposits insured up to $250,000. Deposits are now insured up to infinity. There is no limit. But wow. What they've done essentially by changing the rules of the game is they're changing the reward for risk management. Right. And so now all of these companies that were very, very prudent are actually being punished. They're punishing prudence, and they're providing an incentive for insolvency.
And the families that are having to pay some of the bank fees are going to be part of having to pay the tab for this. It's going to be harder to do banking. EJ, Antoni, thank you so much for joining us. Very enlightening, very informative. Appreciate you stopping by today.
Well, thank you for having me.